All right. Good Thursday afternoon, ladies and gentlemen, investors from around the globe, and all of our Finom Group members. This is our weekly State of the Market. I am your host, as always, Seth Golden, and I am joined by the illustrious Brad Carter. And we are going to get into the heart of things here this week. We've got a rally underway. We're back above 4,000 in the S&P 500, but credit crisis, but bank failures, but a credit crunch that is going to ultimately lead us to a recession. At least that's all we're hearing, right, Brad? So the markets must be stupid for moving higher, right? The markets don't know anything. They're oblivious to all the headlines. That must be the truth, right, sir? What do you think?
It's quite amazing. And I was looking at this morning, and as of yesterday's close, if you analyze my gains so far this year, I'd finish up almost 50% on the year.
And that's because you solely execute your game plan, which is highly dependent on the headlines, right?
Right.
we're being sarcastic here, folks, of course.
But, in a way, it sort of is. They're so predictable. Okay, we know what they're going to do here. Take your profits, and we'll buy it again tomorrow.
Yeah, you play the contrarian. Yeah, I mean, if they're portraying gloom and doom on the financial media networks, you take a little bit of chips off the table, and you just wait for things to move lower. You buy them back, and the market starts to rally again. If we finish up this week, it'll be up 3 weeks in a row.
Yeah.
Ideally for the bulls, I think you want S&P 500 to close the week above 4,000, if not above the early March highs. That would be, the most bullish feat of strength. Tomorrow we got a major piece of economic data coming out in the PCE, personal income and expenditures data, which is the Fed's primary gauge of inflation. So that's due out tomorrow, folks. It will be market moving. We're already pointed up. We're going into weekly options expiration tomorrow. And it's the final trading day of the month and final trading day of the quarter. Let's see if we can finish this one up strong. Anyways, all right, let's get into it here. Our first quote comes from Helene Meisler, famous technician, famous trader. She says, if you came to the markets in 2008, right, the great financial crisis, like if that's when you started your investing career, that you likely will relate everything since and to come to that period. So if you came into the markets in 2008, more than likely, that shaped your experience for years to come. The bad periods of the market or the bearish periods of the market are always going to be as bad as 2008. That's how people's mindset has become if they started their careers in that particular time period. However, rarely, however, do market events repeat so perfectly. Rather, they skip a generation and do something entirely different than what you know. In other words, just because we had a financial crisis doesn't mean that every bear market, even every recession, has to produce another great financial crisis. But that's where people anchor their emotions to, is the most recent cataclysmic, world-ending, apocalyptic moment. So I thought that was pretty prescient from Helene there. One of the things that we also know, aside from the whole credit crunch and credit crisis, which has raised recessionary fears, is that we keep hearing this drumbeat about earnings need to come down. Earnings need to come down. Earnings will come down, depending on who the strategist is that is, being headlined on Bloomberg or CNBC that day. There's this constant drumbeat that the earnings, which have already come down, from basically the end of Q2 through the end of fiscal calendar year 2022. Right now, the expected earnings per share for the full year is about $219 a share, which is basically flat with what the S&P 500 earned last year. But we've already had a couple handfuls of companies report early. FedEx, Micron yesterday, Nike, Adobe a few weeks ago. We've had a number of PVH just recently, number of companies that have reported early, because we don't get into the heart of earnings season until JP Morgan, Wells Fargo, and Citigroup. As if I didn't know that on the top of my head, right? All three of them report on April 14th, so 2 weeks from now. But with the early reports in hand, what we can see is and we've been studying this basically since the fourth quarter of last year, when I believed that earnings had come down to a point where they should have troughed. And so, this goes back to the start of this month, March 3rd. And this is the percent of S&P 500 companies with positive 3-month percent change in forward earnings. Essentially, it's the next quarter's guidance. And what we can see is that we had this really nice spike. We troughed there, which was the fourth quarter of last year. So lo and behold. And ever since then, the 3-month positive percent change in forward earnings has jumped up to, at the start of the month, 60.4%. It troughed at about 47%. So that's how bad things were. And usually it's associated with a recession. Recession when you get under that 50 line. Recession when you get under that 50 line. Recession when you get under that. But not this time. And since then, we've spiked back up. Beginning of the month, 60.4. With all of these early reports that have come up, as of the 24th, we're up to 61.7% of companies have 3-month positive percent change in forward earnings. So the analysts and the strategists are saying earnings have to come down. Earnings have to come down. But the companies themselves that are reporting are saying, guys, things are getting better. We see things getting better than what you guys think they should be. We're up to 61.7% of companies, and that's even before, again, we hit the heart of earnings season. The banks, the financials, they're the first to report. And, with the issues of the, SVB failure, First Republic, Credit Suisse, which has nothing to do with, our banking system. It will be interesting to see, how the bank, the Bank of America's, the JP Morgan's, the Goldman Sachs offer guidance. What I think is that they all had a good quarter. But as we know, the market's a forward discounting mechanism. Investors want to see what they guide to. But so far, we've got corporate guidance and analyst estimates, or analysts and strategists on different sides of the boat. It's the best way I can say it. They're on different sides of the boat. All right, here's something I had said just yesterday. Let me see if I can. Okay. Everyone has opined in favor of an earnings in an economic recession. But what if all the advanced deleveraging of operational cost in anticipation of a recession, even if a recession arrives, only expresses flattish earnings per share on a year-over-year basis? I mean, how many companies have announced that they're going to lay off workers, right? I mean, that's all we heard during the fourth quarter and the first quarter of this year. Layoffs, layoffs, layoffs. That's deleveraging the balance sheet. That's lowering your operational cost. It's as if, all of these S&P 500 companies have already done the necessary work in anticipation of a recession. So what if we've already seen, the meat of the earnings downgrades and the, a better alignment of these S&P 500 companies, assuming a recession? And if they've already done that, what if we get $219 a share, which would be flat year-over-year earnings? And never mind, come June, the markets are not going to be considering 2023 earnings. Brad, what are the markets going to be considering in the back half of this year?
When we get to the back half of this year, unless something changes dramatically that I don't expect, most smart investors are going to be saying the worst is behind us.
Mm-hmm.
That's what's going on.
And they're probably going to be pricing in 2024's earnings.
Mm-hmm. Yeah.
Market's a forward discounting mechanism. I've been saying the bears have basically 3 more months. And if they don't get this market, absent an exogenous event, if they don't get this market down to the lows, forget it. It's game over. And I think the bulls will have won.
You know, and a lot of the bears that I'm hearing, and I don't get to hear them much, but unless I'm willing to listen to your videos when you put them on. But when I do, I've noticed that, you know, they admit that the market is a forward-thinking instrument. And then they say, well, earnings got to come down because they came down last year. It doesn't even make any sense.
I know. Yeah, the market's a forward discounting mechanism when it suits their fancy,
right.
When price action is in their favor. When it's not in their favor, like I said earlier, investors are stupid. The market's stupid. It doesn't know what it's doing. You know, they reach for these straw man arguments.
They're almost like those shows are almost like clickbait.
Yeah.
They're just selling, you know, and if you just remember that, they're trying to get viewers so they can sell advertisement. I mean, that's what that is.
And I love this belief, right? I actually tweeted this out earlier. This is what I said here, Brad. Credit crunch will be exactly as bad as proposed. The economy will contract in exact accordance and to the exact magnitude as people profess. The stock market will decline exactly with the economic fallout as EPS falls presciently. They'll be right. Exactly how it works. Or it never works that way, you know? I mean, everything that we see professed on the finance, it almost never comes to fruition. Almost never. Anyways, these 4 charts right here, just, it speaks to just how pessimistic and bearish the sentiment is out there. The rolling 2-week change in ICI money market funds, I mean, it's $238 billion on the 2-week change. That's the second highest since basically COVID. People just putting money, parking money in money market funds, as opposed to taking risk in the equity market. The AAII survey, the bearish sentiment, is 48.9%. I think the historic average is right around 38%. And the bullish percent is only 20. The historic average, I think, is 35%. We got a lot more bears than we do bulls. How much money is in money market fund assets? $5.1 trillion. That's a record. Since the data has been tracked, that's a record. Nobody's in this market. Positioning is extremely light. And if they're not in the money market, they're in cash. This is the Bank of America fund manager survey, and the highest holdings, or the net percent overweight, is cash. Look at the net underweight, U.S. equities. Fund managers are most underweight equities, most overweight cash. That's the environment we're in right now. People are scared. But they keep bringing on the same professionals, right? The professionals on Bloomberg, the professional strategists, portfolio managers, fund managers coming out on CNBC. Remember back in during the pandemic, just after we hit the bottom and we were up for a good month, Brad, like that month of April was fantastic. We rallied like 11% off the COVID lows, right? And you had Stanley Druckenmiller on CNBC talking about there's no way, that everything's solved. The Fed can't fix this problem. The vaccine isn't, for another 18 months. He decided to hold a public webinar, where anybody could listen in to, this event, because, he thought he was helping people. He thought he was going to save people from the stock market crash that ultimately would take us even lower. Here was they had even tweeted it out on Twitter. This was May 12th of 2020. And here's some of the commentary. The government stimulus programs won't be enough to overcome the economic problems. This is Stanley Druckenmiller, right? One of the most famous, Wall Street Titan fund managers. He says it makes no sense for the market to jump so much when optimism emerges around certain drugs like remdesivir. And most concerning, that there's a good chance that we just cracked the credit bubble. That's the result of free money, right? Because everybody has been pissed off about quantitative easing for the prior 12 years. That never goes away. That's always an excuse for these people. The free money is over. That's what they're saying right now, right? The free money's over. The Fed is tightening. They say this all the time. The consensus out there seems to be, don't worry, the Fed has your back. There's only one problem with that. Our analysis says it's not true. While traders think there is massive liquidity and that the stimulus programs are big enough to solve the problems facing the US, resulting in stratospheric PE multiples, there we go again with valuations, right? The economic effects of the coronavirus are likely to be long-lasting and will lead to a slew of bankruptcies. May 12th, 2020, for those of you who are around and you know your market history only a few short years ago, you remember what happened from this date through all of 2021 and how wrong Stanley Druckenmiller was during that time. And look, this is not just Stanley Druckenmiller. It's a matter of, look, we're all going to be wrong at some point in time, multiple points in times as investors. A professional like Stanley Druckenmiller, just remember the definition of a Wall Street professional. They're wrong or they underperform within a reasonable standard deviation. They underperform within a reasonable standard deviation, but they underperform nonetheless. That's a Wall Street professional. Mm-hmm. So, just be careful out there. If one of these, you see these folks on CNBC or Bloomberg, and, you use their commentary. We shouldn't be using their commentary as part of our game plan for investing. In my
Seth, do you own an equity IRA or something that's managed by other people?
No, I run.
See, I've got one, and what I wanted to share about that is I've got one with Calvert, and it's a pretty good little equity IRA. It's done real well over the years. I beat it every year, whether we're down, we're up, and I beat it by a lot. Last year, I think it was off about 16%, which was better than the market. But I finished up positive, just barely. And in years past, it would be up 22%, and I'd be up 37% every year.
The active portfolio manager, such as yourself, such as myself, such as many of our Finom group members, has an advantage over, fund managers, professional money managers, because we can engage the market more quickly. We can position in and out more quickly, and we can buy dips without regard to redemptions, because who are we going to redeem to? Right. Ourselves, right? So we can buy dips, take drawdowns, whereas a fund manager, a big portfolio manager, can't necessarily do the same thing. What if they're over leveraged, right? Because they bought the dip and now they're taking a big drawdown, and then all of a sudden they get a bunch of redemptions, and they have to start liquidating the portfolio at massive losses.
Right.
right? So
That
we're
and
at
they're
an advantage in that respect.
and on top of that, they're operating under rules of the fund
Mhm.
that we don't have to fool with.
Correct. Correct. We have more flexibility, so on and so forth. Absolutely. I don't, it's not my intention to bag on all of the quote unquote professional, fund managers. I don't envy their job. It's a very tough job. But what I will say, because I've worked in the hedge fund community, consult for hedge funds, is that their priority, unfortunately, is to keep money in the fund. And that involves taking less risk. Well, if you take less risk, guess what you're going to get in the end? Less reward. How do you expect to market perform, let alone outperform under that paradigm? It's just incredibly difficult. So, yeah, I mean, we are at an advantage so long as we, manage our portfolios according to a time-tested game plan, stick to our disciplines, recognize the investing landscape, do our due diligence, so on and so forth. Getting to our first chart of the day. All right, because we've been talking about banks, all we hear day in and day out. I mean, the media just can't stop until we get some other big story, of course. This is going to get beaten to death. The bank crisis, the credit crunch to come, so on and so forth. Now, what I have here is the KBW Regional Banking Index, ticker symbol KRX, and that is a nasty spill. Very quick, folks. It looks like a parabolic move to the downside. What we have here in the bottom panel, and I took this just yesterday on the 29th, the rate of change, this is so rapid. The rate of change over 12 days was 20% plus. Every time that we've gotten to this 20% rate of change line, as you can see here, that was actually a good buying opportunity here in 2009, here in 2011. If you had bought the KBW Regional Banking Index or, good regional banks, you would have done extremely well. And here in COVID, extremely well. Here we go again. We hit the 20% rate of change. Question marks. Will you do extremely well going forward? History says yes. So I'm not saying go out there and buy the regional banks. I'm just saying history says it would not be a bad idea. So just a heads up there. Secondly, if you're worried about valuations, well, the forward PE ratio for the regional banks is literally at a record low. So the valuations are right. And history, so far as our stochastics are concerned, says it's not a bad idea to at least nibble on the regional banks here. One of the charts that we also discussed in the Finom Group trading room this week, and this was a little bit scarier, this is the KBW Bank Index, all bank index here. You see the long trend line from 2009 touched perfectly here, COVID, and it just broke through. That's a bit scary. The way it happened was scary too. Again, the rate of change, 12-day rate of change, gets to the 20% or better, negative 20% or better. I've got the S&P 500 in the bottom panel. Good things don't happen to the S&P 500. 45% decline, 19% decline, 16% decline. Again, we're looking at the rate of change getting to the 20% level. 20% decline here in 2018. Of course, that was COVID. This was 2022's bear market, and we just hit that level again. The good news, right? Because I took this chart on the 24th. The good news is that we did bounce back above this trend line. This is something we have to be aware of, that this is still a looming problem technically. Good things don't happen to the S&P 500 when you have this issue and this issue in the rate of change stochastic. So, where this kind of looks like a good idea, keep in mind, this was a painful period first before really good things happen. Painful period before really good things happen. So we got to keep an eye on this chart here. Like I said before, we did bounce back above. I think we got executed, Brad. We did. We got a profit on VXX, folks. All right. Real time. This is a Finom Group's trade alert here today. So we just made, got our VXX short profit. All right. Well, that's how we do it here at Finom Group, folks. Trade alerts every day, all day. So moving on. Keep this chart handy, folks. This is the BKX ticker symbol. It's the KBW banking index, very broad banking index. Keep that trend line in focus. And hopefully we can stay above this. Maybe this was a false breakdown. We bounce up, hopefully good things going into, bank earnings in the next couple of weeks. The good news is insiders are buying. This is the financials, corporate insiders from the sentiment trader. And as we can see, when the trend line is moving up like this, the insiders are buying in a big way here. Are the corporate insiders dumb money? Or the market's just overly panicked about one bank failure, about one, really nuanced bank failure 3 weeks ago now, right? I believe it was the first week of March, Brad, if I'm not mistaken. And we've not heard of another banking failure since. So, I mean, the insiders are buying the financials, and they're usually very good. I'll get to that in a second. So,
yeah, we need to keep making the point that was a billionaire's bank, and the billionaires sunk it themselves. That's what happened.
Yeah, they pretty much yelled fire in a crowded movie theater on Twitter of all things. So anyways, 85%, if you've been with Finom Group a while, you remember this. And, this is one of those things that I like to bring up from time to time because it serves a purpose. 85% of what you worry about actually never happens. We worry about things that never come to fruition. There was a study from researchers at Cornell University have given us some fascinating insights into worry. They conducted a study that followed people over an extended time and discovered that 85% of what people worried about never happened. Does that sound like good news? Wait, don't answer. There's more. Of the 15% of worries that did actually come to fruition, only 79% of the time, people handled those problems better than they thought they would. They even reported learning something valuable from the experience. Do the math. Do the math, and you find that there was nothing to worry about fully 97% of the time. And that's what we do as investors, it seems like. We worry about black swan events. We worry about this credit crisis. We worry about the recession that people have been worrying about now since the beginning of 2022. We're worrying about an earnings recession. We worry about inflation, which has been coming down now for 10 straight months. And most of the time, we worry for nothing. We worry for nothing. The things that we worry about just don't come to fruition. Like if that's embedded into your emotional quotient as an investor, you've got some homework to do. You've got some homework to do. And again, it's not just that 85% of the stuff that we worry about never materializes, but the 15% of the stuff that we worry about that actually does come to fruition, we manage through it better than we actually thought we could. And we learn something valuable from it. Think about what you are mostly concerned about and what's the probability of it actually being some major catastrophe. All right. Now, earlier this week on the 27th, we also looked at this chart. This is the equal weight consumer discretionary or cyclicals versus the equal weight consumer staples, otherwise known as defensives. And the trend line is going down, which is not very good, right? This peaked here in early February, right? Consumer discretionary was doing awesome. Defense was on the sidelines, but then all of a sudden, we've been rolling over now for basically 2 months. We hit this bottom here, chopped around, made an attempt at going higher, but it failed and we made a lower low. One of the things that we noticed with this more recent low in this performance ratio is that the RSI did not make a subsequent new low along with this lower low here. This is what we call a bullish divergence. Meaning that this lower point here versus this one happened with less strength. Now, it's only slight, so we want to give it time to develop, but literally what we've seen since then is this performance ratio turn higher. So far, this looked like the tell, this bullish divergence there. Always good to look at your performance ratios during the course of the week. I look at semiconductors versus the S&P 500. I look at transports cyclicals versus utilities, defensive. A lot of different performance ratios, which tells us, is it risk on? Is it risk off? Are we pricing a recession? Or are we pricing good things to happen going forward? NASDAQ, NASDAQ, NASDAQ. Say that 10 times fast. No, okay. The NASDAQ 100, I put this chart out on Twitter yesterday. Seth, why do we have to watch your videos if you're going to put it out on Twitter? Because you get the context here, baby. All right, so this chart right here, we've been in this, right, support, resistance. Broke out, we're going, not quite, false breakout. Tried to get resistance again. So 1, 2, 3. 3 times it was resistance. 1 time it was support. Yesterday, we broke out again. And we made a higher high for this calendar year in the NASDAQ 100. Did the RSI confirmed it? It looks like it did. A higher high on the RSI for the year. Here's 2023. This is the highest RSI reading this year. But look at the money flow index as well. That really broke out to the upside. So we have some pretty good confirmations of this breakout here underneath the surface or within our stochastics. So highest level of the year, and it's a 20% from the lows. The NASDAQ 100 is now in a new bull market. It's 20% higher than it was in October of last year. We want to see, obviously, follow through here. But right now, the stochastics tell us we have a clean breakout there. Couple weeks ago, March 9th, we confirmed that there was a 13 by 34 exponential moving average bullish cross on the S&P 500. At that time, the crossing price was 40.40. Back on March, the week of March 9th. Usually, you're going to retest that level. We had consolidation. But usually, at some point, we retest that bullish crossover level. And today, guess what? There we are, folks. 40.44. Exactly where we were that first week of March. So this is a bullish, technical feat of strength within the S&P 500 that happened the first week of March. But since then, the markets consolidate, chop around, and people get bearish. They don't buy dips. They're listening to the headlines. But history tells us that we're going to retest that bullish zone. And here we are today, retesting that bullish zone. And the only reason why I bring this up from a few weeks back is because just the other day, we did the same thing in the NASDAQ 100. We had a 13 by 34 weekly exponential moving average bullish cross. This chart here from David Cox. this chart from a couple weeks ago from West Pike on the S&P 500. So really good stuff happening there, folks. And before either of these bullish crossovers happened, we had the golden cross, right? We had the golden cross in the S&P 500. The golden cross is when the 50-day moving average crosses back above the 200-day moving average. Now, the only thing there is when this happened, which was on February 2nd, the week of February 2nd. So that was, almost 2 months ago now. That happened at 41.79, folks. 41.79, we had the golden cross. Historically, 1 month later, you have a positive percent return of 68. 68% of the time, the market is higher 1 month later. Well, didn't happen this go around. Good news is 3 months after the golden cross, when you are at least 10% from the all-time high, 3 months later, the positivity rate is 87.5%. So that would take us, Brad, to April 2nd. Are we going to be positive, meaning above 41.79 by April 2nd? Unfortunately, the calendar doesn't work out that way, right? That's going to be like April, well, because tomorrow's the 31st, so that'll be April 3rd. April 3rd. So it does not look like we are going to get to 41.79 3 months later. March. Oh, no, I'm sorry. That would be May. May, forgive me.
Yeah, I was thinking.
Yeah, I saw your face. I'm like, what are you looking at me like that, Brad?
Well, I thought I must be wrong, and I kept thinking about it and went.
Yeah, I got it all. Yeah, it's May. May, we have to be at 41.79 for this 87% positivity rate after we did the golden cross.
I think our shot at getting it is actually pretty good.
I do too. And remember, I don't want people to forget, we also had the first, what was it? CNBC Markets in Turmoil on May 5th of 2022.
Wow.
A year later, the market has never been lower after that first Markets in Turmoil episode. And guess what the price of the S&P 500 was on May 5th of 2022? It was 41.50. 41.50. So early May, we've got two signals here with very high positivity rates. It's 100% of the time after the Markets in Turmoil episode. 12 months later, which would be May 5th, we have to get above 41.50 for that to be perfect still yet. So a lot of bullish feats of strength have been happening. My point on rehashing and introducing some of these other technical feats of strength is people, again, they just think that the markets are stupid. They haven't been buying the dip. We got all the way down to, what was it, 38.30 just a couple weeks ago. And here we are, we're 200 plus points higher. People forget the breadth thrust. They forget these quantitative studies. They forget these technical feats of strength, because when price goes down, we lose our disciplines. Many investors will lose their disciplines. They will forget what they know in favor of those headlines, unfortunately. Last one here that I want to remind us of. Oh, well, I had asked the question, do you think the insiders are stupid buying the financials, right? I had shown, that chart that the insiders are buying the financials like crazy right now. So this chart, and look at the date, folks, June 28th of 2022. It was last year, June. The NASDAQ buy-sell ratio from the corporate insiders, look at where it was. The NASDAQ insiders were buying at the highest rate since 2011 and 2012. The buy-sell ratio was higher than even COVID. This is why I say, do you think the insiders are stupid? Now, the NASDAQ 100 back then, let's see, on June 28th, 2022, the NASDAQ 100 closed at 11,637. Coming into this trading day, the NASDAQ 100 was 12,846, or roughly 10% higher. Would you have welcomed 9 months later a 10% profit, Brad, if you had bought back there in June? I would have. I would have welcomed that profit. Like, it was scary to buy back. That was almost the low for the NASDAQ 100 year to date back in June. Like, it was really scary times. We just got a CPI that printed the 9.2%. Nobody wanted to buy. But the insiders, they're pretty smart. They're pretty smart. And we're 10% higher than where we closed on June 28th. So, going back to the question I asked you, do you think that the insiders for the financials are stupid with how much they're buying today? And this is probably going to keep going higher.
I think I bought banks 3 times in the last few days.
I want to add to my JP Morgan, but I'm getting a dividend. So I'm going to, I'll wait and see what their earnings look like. I've got enough of JP Morgan. I've held it for more than a year. That's kind of my blue chip bank. So, I mean, if it's going to go bad for JP Morgan, it's going to go bad for everybody else. So that's kind of where I stand.
Yeah, true.
Now this is, this is CNBC, Michael Santelli. This is what I mean, folks. This is what the insiders were doing last year. And this is what Michael Santelli, with this mystery broker of his that he promotes on Twitter all the time. The mystery broker, this was just the other day, update overnight reiterates his bearish stance on stocks and low assessment of the quality of the post-October rebound. He remains upbeat on longer-term treasuries. Called 4% 10-year yields a gift a few times in recent months. Expects recession not far away. That's what I mean, folks. If you're acting upon the CNBC folks, you've just missed out on yesterday's 1% plus rally in the S&P 500 and almost 2% rally in the NASDAQ. Again, as an active portfolio manager, you can trade in and out much quicker. You can build core positions by taking advantage of the dips in the market. But if this kind of stuff makes you sit on your hands, you'll never be able to improve your cost average. You're never going to be able to buy those companies that you truly do believe in, that have long-term, good long-term track records, because these kind of folks are scaring you with this kind of language. Be wary. Be wary of those folks. It doesn't feel good out there. Still, it doesn't. Year to date, the NASDAQ is up some 16%. S&P 500 is up 6%. It doesn't feel good because we've kind of been in this protracted bear market, and it seems like new all-time highs will take forever to get to. This table here is from Ben Carlson of Ritholtz Management. And he says this table looks at the drawdowns for each bear market, the number of days it took to go from peak to trough, and the number of days to go from prior peak to new highs. Let's see here. Number of days to new highs, 436. When you've gone from the peak to trough number of days. I mean, wow. That's a long, some of these 2,744 days to make a new high after you had that 48% correction, 73, 74. The average, if we included the current bear market, the average peak to trough drawdown is a loss of a little more than 35%, a little less than 35%. The average number of days to go from peak to trough is 381. It's about a calendar year. The average number of days to go from the previous peak to new all-time highs is 1,166 days, or more than 3 years. So that's why people still feel the way they feel. This is a very protracted period where we haven't seen a new all-time high. Coming off of 2021, where we had over 70 new all-time highs in just that calendar year. People aren't used to this. Last time people saw something like this was, from 2007 to 2013. Right? I mean, we had the great financial crisis, and it wasn't until 2013 that the S&P 500 made a new all-time high. Not saying that's going, that's how it's going to be this time. It could be as quick as 181 days like COVID. It's not this time, obviously, but 1957, 436 days. You never know. It's very random, and this is just the average, folks, just the average. Richard Thalier's behavioral finance term of the phenomenon is myopic loss aversion. Loss aversion is the idea that losses sting twice as bad as gains make us feel good. And that's where people are. They're still in this cycle of thinking about losses because we had a bear market down 25% last year. A lot of people took a lot of losses. So their mindset is still, I don't want to lose more. I don't want to lose more. I don't want to lose more. So how can I avoid losing more? That's what Richard Thaler talks about. It's this feeling of loss aversion that is keeping people, honestly, from getting back to even more quickly than they otherwise would. All right, well, this study that we brought up several times before, Bank of America Global Research, this is when we've had this, the S&P 500 enters the best part of the presidential cycle with declining 40-week moving average. That's the technical moving average that has been declining. When we ended there, fourth quarter of a midterm year, through the first quarter of year 3 of a 4-year presidential cycle. I know that kind of sounds very jumbled there, but this is where we're wrapping up. The fourth quarter of a midterm year, the first quarter of year 3 of a presidential cycle. The S&P 500 finished October of last year, 3871. And we couldn't finish above, by the end of the year. We did not finish above that level. We finished at 3839. When technically the positive percent rate was 85% for that fourth quarter. So where does that bring us now? This column right here. Technically, we have never historically failed to be higher than where we ended the midterm year. We ended the midterm year again at 3839. Looks like we are going to end this quarter higher than that. So this remains perfect. And again, this is why we keep this quantitative data handy, because history doesn't always repeat perfectly, but the higher the percent probability rate, you want to keep those studies handy. This is one of the reasons when the market was dropping down to the 3830s over the last couple weeks, we were buying this dip because we are in a very seasonally favorable and technically favorable part of the year. Now, from the Q4 period of last year through the second quarter, look out, folks. You still have a 100% probability of being higher. So we should still be above 3839 by the end of Q2. But what about a recession, Seth? What about a credit crisis? What about a credit crunch? They're talking about fewer loans, and that's going to, cause a slowdown in the economy. What about the deleveraging of Fortune 500 companies already, folks? What about them already being well prepared for that so-called recession in advance? And what about the market not being a forward discounting mechanism? That's what this speaks to. So we'll see how the second quarter goes as we kick that off next week, but keep this number handy and remember this study. We should be above 3839 by the end of the second quarter because the market has never been lower.
Something else, Seth, that I think we try to emphasize, but maybe we need to emphasize a little bit more. We're rapidly approaching the point where, based on the way the earnings are coming in and so forth, that there can't be a recession this year.
It's going to be difficult. You really do need this credit thing to get worse. I mean, it can't just be Silicon Valley Bank. It just can't. It's got to get worse if we're going to have this recession.
And we keep hearing good stuff from companies reporting, and so I'm going to go out there and say no recession this year unless earnings really start turning over in this quarter, and I just don't see that happening.
Yeah, I mean, we heard from Carnival Cruise Lines. Get to that in just a minute. We heard from their CEO just last week. He said, "I get it. Yeah, I get it. You know, this bank failed and people are scared, but we're not seeing a slowdown in bookings."
Yeah, and how discretionary can you get?
How discretionary can you get than a cruise? That's my point. Exactly my point. Nobody needs a cruise. So we've got these contrasting stories from the media and from, like I said, the companies themselves. You've got the analysts and the strategists saying one thing, and you got the companies saying something completely different. All right, our next study, as a reminder, Quantifiable Edges reported the firm's proprietary 7070 breath thrust occurring with a BAM and a Whaley breath thrust. That all happened back in January, mid-January. We had this trifecta of breath thrust. So that was January 12th, folks. There have been 7 instances where 2 of the 3 breath thrusts triggered on the same day, which is represented in this table here. They can all be found in the table. The S&P 500 closed on January 12th at 3983. 42 days later, or more than 2 months later now, the market is higher than when the signal fired on January 12th. Here's the column. Here's the percent positivity. The win rate 2 months later, 86%. Again, 3983. Here we are today, folks, 4049. So far, so good. 3 months later, or 63 trading days, which is basically 3 calendar months, the market has never been lower when it's fired 2 of these 3 breath thrusts. So we should be higher than 39. We should be higher in the S&P 500 in the month of April to come. We should be higher than 3983 based on this happening. So another study that has worked, just like this study, which has proven its efficacy. The last study here from, I think this is Fundstrat. Yeah, this is Fundstrat. And this is March through April, right? We're done with March. Assuming nothing bad happens tomorrow, we should be positive. But this is March through April, which is typically in year 3 of a 4-year presidential cycle. Is almost never down. It's actually, the win ratio is 100%. 100%. When we've had the first 5 trading days of the year, a greater than 1.4% return, which happened this year. We had a greater than 1.4% return. March through April, the market has never been down. So that also from Fundstrat. We need to keep this in mind. Obviously, this takes us through the month of April. I think those are the studies that we have for this week. So I'll wrap it up with just some notes here from Jan Heisis of Goldman Sachs. He's their chief economist, and he says he doesn't see this as being some credit crisis event. He does say that the chance of a recession within the next 12 months has risen to 35% from 25%, but that's still well below the consensus Wall Street of 60% recession probability. The reasons he doesn't see, the conditions there is, first, lending already looks lean. Banks have tightened up on credit since the middle of last year. Second, large banks in particular, which have higher liquidity standards than small ones, are unlikely to reduce lending forward. Remember, they're banks, folks. How do they make money? They loan it out, and they charge you a fee. So, for them to, if they're going to crimp their lending, well, then their earnings are going to go down. Third, this crisis, which was set off in part by banks' losses on their treasury bonds, has sent investors into those same treasuries, pushing prices higher and reducing paper losses for the lenders. It actually works in their favor that we had this bid in treasuries. That's the opposite of what happened in 2008, when assets at the center of the crisis lost even more value. Last but not least, commercial real estate, a big source of loan demand for small banks, was already struggling. So a reduced supply of loans there might not even have a big impact. All of this suggests that the current bank crisis will be a headwind, but not, as Jamie Dimon has consistently said, a hurricane. It's a headwind, not a hurricane. Folks, we had headwinds all last year. The Fed, higher rates, manufacturing recession, housing transaction recession, car prices through the roof. We have different headwinds this year, but it's not a hurricane, according to Goldman Sachs. Here's the commentary from the CEO of Carnival Cruise, by the way. Here's the commentary where he says, we're doing fine. So you can read it at your leisure, folks. Looking at some of the high frequency data since this bank failure thing, you can go also to the Bureau of Economic Research. You can go to their website. They keep track of card spending data. And we did have a drop here, but it has since rebounded. This goes to last week. This goes through last week. It's updated every week. But we've had these drops before also, folks. And they rebound, just like it's done this time. So we're not seeing anything in the high frequency data that says the consumer has changed their habits just because of these headlines in the banks.
Seth, did you see that headline where little bitty New York Community Bank bought some of the assets from that bank failure?
I did, yeah.
That tells you right there.
Right. It's like, there's a saying something about what happens on the coast is not what happens in America, or something like that.
Yeah.
You have a New York bank buying the assets, an East Coast, bank buying the assets of a West Coast bank. Yeah. Commercial banks, folks, everybody says they're going to stop lending. This is basically the highest level we've seen in months. Highest level we've seen in months. Banks are supposed to stop lending. And granted, we need more time to see how all this plays out, but still. U.S. commercial, another reason why this is not likely to be a crisis is because the bank to loan deposit ratio is in such good shape. The U.S. banking system is extremely well capitalized, folks. Meanwhile, the loan to deposit ratios are below pretty much any point in the last 50 years, showing banks have far greater capability to meet withdrawals. So if the depositors want their money back, they have far more capability to meet these withdrawal requests without damping illiquid assets, than the headlines are giving them credit for. Everybody's throwing out JP Morgan, Bank of America, Wells Fargo. They're throwing out these stocks, but their loan to deposit ratio is in fantastic shape. They're not illiquid. They're not insolvent. This is not the great financial crisis. And usually when you have this going down is when you have bear markets. It's going up now.
Seth, I remember hearing something on, it may have been one of the videos you were showing from an MSNBC clip or something, but I heard somebody, and it was a personality I know, but I can't remember who said it, but they were saying banks are loaning out 9% of their money. And I just doubted that. So I looked it up, and that's on the rare side. Most of them were 75, 80, 82, there were numbers like that. But they are allowed to loan out a high percentage of what they have.
Yeah, they use it at leverage, but even so, as that chart shows, right now their loan to deposit ratio is literally at 50-year lows.
Yeah.
They are, and their capital position is fantastic. So I guess we'll wrap it up by saying we do need this situation to evolve a bit so far as the information flow is concerned. Respect the tape, folks. Price is not stupid. you know, the market knows. The market knows. It's a very savvy forward discounting mechanism. We get into earnings season 2 weeks from now. We've had some bullish technical formations. We've got one very bearish one within the banking index that we got to keep an eye on. I would say tread cautiously, but optimistically as well. Always have a good framework within your emotional quotient. Think positively. You can act on local price discounts, assuming you have a long-term time horizon. Always think of the glass as half full when you're investing or trading. Never trade what you're not willing to own either, folks. And speculation will generally get you into trouble. With that being said, thank you for tuning in once again to State of the Market, and we will be back next week, folks. Trade
See ya.
safely.